Are you still short that? And how did that impact your thinking on your positioning?
So Tesla, and we told clients in January, February, that the 3-month period, sort of November, December, January, was one of the craziest periods I've ever seen in my 40 years on Wall Street. And if you remember, and I know Josh saw some of this stuff, and maybe some of your other panelists, retail for some reason came pouring into the market in individual names and individual stories in a way we haven't seen really since sort of January, February of 2000 at the end of the dot-com boom. And we saw the parabolas, we saw the Teslas, the Virgin Galactics, and others. And we saw it in the data of retail trading at E-Trade and options and Robinhood and so on and so forth. And I had not seen, that was the one thing that had been missing in this bull market in the 10 years, was just manic speculation by individuals. Well, sure enough, by January, February, we had it. And, we saw these stocks go parabolic. And if you're parabolic and you're short, obviously your position's getting much bigger. So in situations like that, if we like the name, like we like Tesla, we will have to cover some if it goes through our risk parameters, but then we will sell it even back down if we want to keep a maximum position. Again, one of the challenges of the short side is that you get bigger when it goes against you, and you get smaller when it goes your way. We are still basically maximum short Tesla. It's still one of my favorite positions. Nothing's changed in my viewpoint here. This is a car company. It will lose money again this year. What I find fascinating about Tesla is that the 2021 estimates, which track the stock on the way up, are now being cut dramatically. I think Tony Sacconaghi, who you know, cut his 2021 adjusted EPS number yesterday from $18 to $11. I mean, that's not affected by the virus. So, I mean, we're seeing big number cuts in this company. They're building 2 plants. They finished China. They're building Berlin. They are increasing capacity, I think, exactly at the wrong time. And if you know anything about manufacturing economics, you know that units, you also need to cover your overhead if you're building more and more capacity. And if you're not producing at 90+% of capacity, you're basically not going to be profitable.
But from a risk standpoint, you did cover some of the Tesla short when your position got larger because the stock had gone parabolic, as we said?
Yeah, we have a 5% limit on our funds. So if anything goes through 5%, we have to cover. But on the other hand, we will add on the way down if we still like the position. And it was a very instructive story, and that was a company called Valeant Pharmaceuticals that went from 130 to 260 on us, and we had to start covering stock at 180 and 200 on the way up. But then we sold it all the way down.
Do you think, though, the fundamentals of the balance sheet of the cash position have improved? You would admit that, though, correct?
Oh, yeah. It's not an insolvency story, at least not here and not yet. But it's also got a market cap, that's $89 billion and an over $100 billion total enterprise value. This is a company that hasn't made any money since its inception, and is not going to make any money this year, and is not going to have 1 million robo-taxis as it promised this year. And so it's a car company. It seems so simple to point that out to people, but you have to keep doing it. Car companies did trade at 1/2 of revenues. Now they trade at about 0.25 of revenues. And of course, Tesla is trading at 4 times revenues. So the risk reward is I think, somewhat self-evident.